So today what we're going to talk about is prepayments, accruals, accrued income and deferred income. Now, I know a lot of you have had questions around this before today, and it's something when you're first starting in finance, it's quite hard to get your head around it, and you hear these terms thrown about a lot across an office or in the books that you're reading for AAT or for other finance exams, but sometimes they're not very good at explaining exactly what they are. So I'm going to talk about them this morning, and hopefully by the end of this video you will be able to understand exactly what a prepayment is, what an accrual is, what deferred income is, and what accrued income is. So just as a basic rule in finance, we tend to start with the debits. So a general good rule of practice when you're doing your journals is to start with the debit and end with the credit. So we're going to start with prepayments. So what is a prepayment? So a prepayment is something that you have paid for but not yet used. Now, what does that mean? You might have received a telephone bill that goes from July all the way through to August, so the 1st of July to the 31st of August, but you're only reporting up to the 31st of July. So in that instance, you are paying on an invoice for an additional month's worth of telephone costs that you have not yet used, hence something that you've received that you've not yet used. So what we need to do is we need to prepay those costs out. And again, what does that mean? So what does it mean when I'm saying I'm going to prepay something? It means that as at this moment in time, I have those costs sat in my profit and loss. And what I need to do is strip those costs out because they are not relevant to the month that I'm reporting on. So what we do with that is, if you have a look at this T account that I've got up at the moment, is we're going to credit the costs that are sat in the profit and loss, and we're going to debit prepayments on the balance sheet. Now again, just as a rule of thumb, and something that I've learned over the past decade or so, is that if you start with the balance sheet when you're first starting out and first getting into finance, it's a lot easier to understand where postings should be made and the whole debit credits process. So if you start on your balance sheet and you debit to prepayments by, let's just say the invoice was for £2,000. So £2,000 is in £1,000 for July and another £1,000 in August. So we're going to debit the prepayments with 1,000, and we're going to credit telephone costs in the profit and loss by 1,000. So again, we are reducing the cost size in the profit and loss account, and we're increasing the prepayments that are sat on the balance sheet. So there's your debit and credit. Okay, so let's move on to accrued income. So what is accrued income? So the very simple version of this is that it's income that we are due to receive and we are owed, but we have not yet received. So this might be where, for instance, you have a charity company who is due a grant for the month of July. We keep using July as an example, but we'll continue. So you're due grant money of £10,000 from the government for July. You have not yet received that money, but it is 100% due for July. So it's not currently sat in any of your ledgers, it's not currently sat in your accounts anywhere. So what we need to do is add in that revenue into the income statement. So if you look at the T account that I've got up now, you will see that we're going to credit revenue, because revenue is always a credit, it's turnover. So we're going to increase the revenue that we have by £10,000 by crediting revenue, and we're also going to debit accrued income because we are accruing for income that we have not yet received. So again, slow it down. So we're going to debit accrued income, in other words, a debtor to the balance sheet. So we're going to increase our debtors on the balance sheet, and we're going to credit revenue. So we're going to increase the revenue in the year, and therefore the impact on the profit and loss account is that we've increased the profit and loss in the period. So moving on, accruals. What is an accrual? So an accrual is basically the opposite of a prepayment. If you can remember prepayments, you'll do well to remember what accruals are. So an accrual is something that you've used, but you have not yet paid for. An example of this would probably be something like electricity bills, or again, gas bills, things like that. So they tend to bill after the event. So you might receive a bill at the end of July, that's a month behind. So that bill that you've received so far in July is only for June. So you know that you're going to be receiving an invoice next month for this month. So if you can see that the costs that you had for the month of June were again £1,000, and if you look back and you can see, well, we've been charged about £1,000 every single month before that time, then you're going to accrue for costs for about £1,000, because that makes sense, and they're your estimated costs. You could go one step further and contact the supplier and say, can you give me an estimate? But that's not always feasible in the real world. So what we're going to do, if we have a look at the T account that we've got up here, this time we are going to credit the balance sheet because we want to increase our creditors, so amounts that we are due to pay out, and we're going to debit, in this case, telephone costs. So we've got a credit to the balance sheet and a debit to telephone costs. And what does that mean? So that means that we're going to reduce the profit and loss that we've got in our accounts, and it means that we're accurately recording the invoice that we're going to receive next month that relates to July. So it's all about the time period. So you want to make sure that you're reporting in-month costs in month. So if you know you're going to receive costs, you've got to include those as well. So I'm just going to make a disclaimer here that this is not cash accounting. This is accrual accounting. So cash accounting would be accounting for items that you receive as and when. Accruals accounting is all about timing and month end. So moving on. So what is deferred income? So deferred income is where you've received income that you're not yet due to account for. So you received it, but you can't account for that money as yet. So let's use an example. So you've received £120,000, and we'll just use the government again in this example. So you've received 120 grand of income for 12 months that relate from August last year to August this year. Now, if we were to split that by the months, that would be 10 grand a month. So we know that 10 grand of that income that we have received relates to next month. So we can't account for that. So we'll be accounting for that next month. So what we need to do is take out that revenue. So we call that deferring the income. So what we're going to do is reduce income that we have stated in the income statement, and we're going to basically push it out onto the balance sheet, and next month we'll reverse that. So here we're going to debit revenue. So we're going to decrease revenue because we all know, again, that turnover is a credit on the income statement. So by debiting it, we're reducing the revenue, and we're going to credit deferred income because we are creating a creditor, almost, on the balance sheet. So by doing this, we are removing all of that revenue that we've received that we're not yet entitled to, and we're putting it onto the balance sheet. So next month, we're going to debit income, deferred income, and credit revenue when we take the revenue on. So to recap here, let's just go through some questions. So question 1, just to test your knowledge. What am I describing out of prepayments, accruals, deferred income and accrued income if I'm asking you about something that has been paid for but not yet used? So the answer is a prepayment. So question 2, something that has been used but not yet paid for. So the answer here is an accrual. Question 3. So am I describing deferred income, accrued income, prepayments, or accruals? If I say income that we have received but that we are not yet entitled to. So the answer there is deferred income. And question 4, income that we have not yet received but that we are entitled to. And the answer there would be accrued income. So make sure that you stay all the way to the end of the video for my top tips that I'm going to share with you. So my top tips, and something that I learned quite early on in finance, is the double A rule. So it's all about the double A rule. So what that means is that we can't have accruals and accrued income together. So if you remember that rule, you'll always know that accrued income is not a creditor, it is a debtor, and it can only ever go with prepayments. So you can only ever have prepayments and accrued income and accruals and deferred income. So just always remember that, the double A rule. 2 A's cannot go together. And if you remember that, then you should be able to go a long way with this. So I'm going to be producing more videos like this, so if you do like this content, please subscribe, leave a comment, like, and yeah, I'll see you on the next video. Thanks for watching.